Welcome to the Significance of Wealth podcast, where we explore the evolving landscape of wealth management, private investments, and collecting as both a passion and investment strategy. I'm Marty Salt. Today, we're joined by Michael Grayson, a portfolio manager at First Trust Capital Management, where he focuses on event-driven and multi-alternative strategies, as well as the firm's private market platform. Michael brings deep experience across alternative investments and private markets with a background that spans investment management, product development, and working closely with family offices and institutional partners. Before we begin, a brief disclosure. This episode includes discussion of past private and alternative investments for informational and educational purposes only. Nothing discussed should be construed as an offer, solicitation, or recommendation to invest in any specific security, fund, or strategy. Alternative investments are speculative, involve a high degree of risk, and are intended only for investors who meet applicable qualification standards, such as accredited investor or qualified purchaser requirements. These investments are not suitable for all investors, may involve limited liquidity, and can result in significant loss of principal. Listeners should consider their financial situation and consult their own financial, legal, and tax advisors before making any investment decisions. In this episode, Tom and Michael discuss how institutional-level due diligence, disciplined underwriting, and ongoing access to private markets support the investment process for Destiny Family Office clients. They explore how liquidity, secondary markets, and potential exit paths such as IPOs are evaluated in late-stage private investments, offering listeners insight into the frameworks and considerations that inform these decisions. And now, here's your host, Tom Ruggie.
So today I have with me Michael Grayson, effectively known as Grayson to myself and many others. We actually utilize Mike's firm to set up our Destiny Alternative Fund, which is now about a little bit over 4 years old. And more recently, over the last 2 to 3 years, we've been doing an awful lot of direct investments with Mike and his firm. So we're going to talk a lot about those today and get Grayson's insight and directionally where things may be going in his opinion and whatnot. So Grayson, happy to have you here. Thanks for joining.
Yeah, I really appreciate it, Tom. I feel like this is long overdue, so I'm happy to be on and looking forward to the conversation today.
Awesome. Well, let's start off. Maybe just tell us a little bit about yourself, how you got into the business, what motivates you at this point.
Yeah, happy to. Grew up in Chicago. Our office is in Chicago. Went to school in New York, another cold climate at Colgate, studied economics many years, 15 years ago. Got connected with a family office coming out of school. Had a kind of relationship with one of the partners there. There were 6 original partners of the firm, all very successful ex-traders on the Chicago Board of Options Exchange, a couple kind of north of $1 billion net worth families. And there were 6 primary or core families where we were investing all private partnership capital for those families. And we grew the multifamily, we called ourselves a multifamily office business. We grew the multifamily office a little bit and expanded to some additional families over a 5 to 10 year period. But the focus of the business was 100% private placement investments, mostly equity and debt focused. So private equity, we were doing a decent amount in private debt, which we've also had partnership with Destiny on, of course, and really developed to have a niche within mid-late stage growth equity investing with partnership capital, and had a couple strategic relationships with family office clients, Destiny being one of kind of the exclusive relationships where we started partnering on these opportunities. The family office I was with did a joint venture with a firm called First Trust 5 years ago, and that really helped expand the access that we were getting to these private companies, specifically just because we put a little bit of brand behind our multifamily office business. First Trust is a $320 billion asset management firm. They have a large public business. A lot of these companies that are pre-IPO really like to align with some of the mutual fund companies like a Franklin Templeton or a Fidelity or a T. Rowe Price. And First Trust is in that kind of network of large ETF and mutual fund shops because they want you to support the stock after the IPO. And so some of the kind of relationships that we had with management teams and venture firms to source access to growth equity and venture deals prior to the First Trust partnership, coupled with the fact that we were able to lean a little bit into the First Trust brand on the post IPO storytelling, has provided us really exclusive access to where I focus 100% of my time on mid and late stage growth equity investing in large pre-IPO businesses. We've done a lot in the Elon Musk names together. We've done a lot in kind of other next generation technologies like defense technology, certain enterprise software companies, a decent amount in AI, and then some other frontier technologies like robotics. We've been looking at quantum compute. Together, we've been looking at nuclear fusion. Recently, together, Destiny and my kind of multifamily office business. And the kind of thing we pride ourselves most on, which we can talk about today, is always aligning ourselves with clients with partnership capital. So we really source these deals through the lens of, do we want to invest our own capital into these opportunities first and foremost for alignment purposes and because we think the investment thesis is compelling, and then have the opportunity to bring them to family office clients that we work with collectively.
So we have been investing in quite a number of mid to late pre-IPO companies. I mean, just in 2025, we've invested in Anthropic, Anduril, SpaceX, XAI, Databricks, Crusoe, Stripe, and Agility Robotics, all of which I would put into that somewhat later stage. I feel like once we get through this cycle, if you will, that it may revert back to more smaller, mid-sized companies. Would you agree with that? Or do you think once we get through this technology cycle that there's going to be other up and coming late IPO type stage type companies?
Yeah, I definitely think it'll be situational based on capital market environment. So our IPOs open or close, IPO markets open or closed. Right now, we think, and we talk about this almost every day together, how we're at this really unique inflection point where you have these generational potential companies like a SpaceX or an OpenAI or an Anthropic or a Databricks that have been around for a while. Like a lot of these companies have been around for 10 years. We had a tough market environment coming out of 2021 and 2022, where we've had almost no IPO activity now for 3 straight years. And finally, it seems like IPO markets are reopening. And a lot of these businesses have some AI component to them, but there are really some generational opportunity sets in these underlying businesses where it seems like we're at this kind of perfect storm of having access to pre-IPO companies still relatively early in the game, but we're going to see a lot of IPO activity, I would hope, over the next 12 to 36 months in this universe. And so you don't want to say like this is, I don't think we've thought about this as being a trade where we're like, oh, we're going to tactically put this trade on where there are these pre-IPO companies and we're going to capitalize on them over the next 12 to 36 months and then flip them through IPOs. But the investable universe will definitely change over the next 24 months once a handful of these companies or more actually go public and are now accessible in public markets. What that means is we'll continue to evolve the program, potentially a little bit more into mid-stage companies. I do think there will always be private businesses that are on the kind of brink of IPO where we'll continue to focus, partially because at least the way I think, and I think I speak for both of us, our partnership capital really thinks about mid-late stage being the sweet spot where there's enough juice to squeeze on these investments to make upside return, but we're not taking binary risk of early venture investing. That's how we want to invest our own capital. Like if we can make a 2x or a 3x or a 4x, obviously we can talk track record and portfolio companies, but if we can make consistent, strong IRRs and good multiples for investors over shorter holding periods, so maybe 2, 3, 4, 5 year holding periods, that's a really good outcome.
Yeah.
For a family office client, we don't necessarily have to swing for like the early stage investment that's either a 10x return or a 0. And so that's why collectively we've always really focused on the companies that are maybe 12 to 36 months out from an IPO and shied a little bit away from the businesses that are so early stage and a bit more speculative
Yeah.
in nature.
No, we definitely have the same thought process. And ironically, one thing that I've been quoted as saying many times is I believe that we're in a once in a generation moment right now, specifically, not just with the investments that we've made, because there's other great companies that are out there that we have not brought to the table for our clients. And there's been one or two that we talked about bringing to the table, like CoreWeave, that we missed the boat on. Nonetheless, the reason we didn't do CoreWeave was because we brought Anduril to the table. So you have to take a trade-off here and there, but it is, again, in my opinion, just an amazing opportunity set that we're in right now. And I'm also in agreement that the next 12 to 24 months is going to be a very exciting time for a lot of the names that we've brought to the table. Can you talk to me a little bit about your vetting process? And when I say your, First Trust, Vivaldi, et cetera, and perhaps even the escalation of the vetting process above and beyond you, because most of our deals coming directly from private equity firms. So obviously they're doing a significant amount of vetting before it probably crosses your all's desk.
Correct. Yes. Happy to. There's really two layers of the diligence process. So the first I'll talk about is like a little bit more market oriented, where we don't believe collectively this is a do-it-yourself marketplace. Like, there are institutional players in this market, which we would pride ourselves on being one of those counterparties, that are providing really high quality solutions to high net worth and family office clients. Best execution on price, reasonable fee schedules, appropriate structuring of these investments where you actually control the asset and safeguard client assets that way through structuring. You invest alignment, so investing your own partnership capital alongside the client's post-close support. So like making sure you're providing regular updates to the end investors. Like, those are all things that an institutional firm is going to provide an end client. That's paramount to the outcome of the investment. These are non-investment thesis related items. So like, before we even get into thesis, it's making sure like we're executing like institutionally. The non-institutional market, which really dominates the space, is really almost the Wild West. Right now, you have large brokerage platforms running around with supply in these companies. And when I say these companies, like, we'll talk about the businesses we're focused on, but think about like a SpaceX or an OpenAI or an Anthropic or an xAI or a Databricks. Like, these are names and companies in Anduril Industries. We've done a number of Anduril transactions. Businesses you might know, like they're on CNBC, Wall Street Journal, 60 Minutes. There are brokers all over the marketplace, independent at kind of the large brokerage platforms, that are like preying on retail investors. And then there's a bunch of suspicious counterparties also that are basically masquerading as venture firms. Anytime you get a market like this where there's a really, as Tom noted, a once in a lifetime potentially or generational opportunity set, like, it's going to introduce a lot of shady counterparties to the marketplace that you need to be careful with. The brokers intermediate trades, connect buyers and sellers. There's double-digit percentage commissions in this market. So like, think about a real estate. These transactions are almost like real estate, directly negotiated between a buyer and a seller. There's a broker in the middle of the trade. In the venture market that we're talking about, in the high demanded names, those are double-digit commissions the brokers make on both sides of the trade. So like, you're paying a broker substantial upfront fees. There's no alignment because they're not putting their capital into it. It's a very transactional relationship. So you get no post-close updates on how the investment's performing. So you're pretty much shut out and in the dark immediately after you close. They also do shady things like mark up the share price on these companies regularly, like almost every single transaction, because there's no market exchange for these businesses. So do they know whether SpaceX is a $212, or does the end investor know whether SpaceX is $212 per share or $250 per share? It is 212. Last transaction would be 212. That's institutional market pricing. A lot of this Wild West retail dominated marketplace pays big embedded premiums on price per share. And so if you're interested in the space, the thing you have to do is make sure you're aligned or with one of those institutional counterparties and not trafficking in the retail kind of dominated Wild West brokered market that comprises 90% of this marketplace. Because you're getting taken really one way or another, whether it's their price, big egregious fees, multiple SPV layers.
In this conversation, are you including purchasing these investments directly in the secondary market?
The secondary market is, I'm referencing the secondary market, but the brokered secondary market. Like
Gotcha.
we've done secondary transactions where we've bought shares from a shareholder of the company through a directly negotiated secondary, but we were able to drive terms. In that transaction, for instance, an example is the Reddit deal that we did together in late 2023. We bought shares from 3X employees pre-IPO. That was a directly negotiated secondary. We knew those 3X employees needed liquidity. They'd departed the business. They'd lost touch with kind of the progress of the company. A lot of times they're motivated to sell. Like they had tax liabilities, specifically these three individuals that they had to meet. So they needed to raise liquidity, and we were able to negotiate. We entered that one at $29 per share. That was a $5 billion market cap on the company. The stock's trading north of $200 per share right now. So there are certain secondaries where you can situationally get great access and execution, like the Reddit trade that I just walked through that has a great outcome for investors, but that's because we were collectively driving the terms institutionally. The market I was referencing is really the Wild West secondary marketplace where a broker gets their hands on SpaceX shares and they're marking them up and there's egregious fees in the middle of it. That's most of the secondary marketplace, I would say, carries that negative connotation where it's really aimed at exploiting demand in these names and potentially to the detriment of retail investors. So that's two sides of the marketplace. You need to make sure if you're interested in these names that the counterparty you're engaging with, whether it's First Trust or Destiny, is institutional. So we pride ourselves there. Secondly, we spend a lot of time obviously underwriting the individual companies, understanding the business models, understanding the IPO visibility of the company, understanding kind of the unit economics and competitive moat that the company has, and then just all the KPIs. So like the full financial model, having access to that under NDA from these companies so that we can really understand financial performance and projections for the companies, having information rights where we have access to financials. That's how we not only underwrite the business, but also keep the investors up to speed on the investment post-close, whereas brokers don't have any access to that information. And so you're really making an investment, just frankly hoping the company IPOs and you have a monetization event for the business. So
Yeah.
let me just take a pause there.
So I know there's been several situations where we were talking about gaining access to a company, and after some due diligence, we ultimately decided not to move forward. Can you, without naming the company or companies, but can you give some examples of a situation where there was a pretty deep dive done, but ultimately the team said, hey, we're not going to do this?
Yeah. And this is where the alignment comment I made is so important. Like if your counterparty that you're working with is investing their own capital meaningfully, they have skin in the game. So they're not incentivized. We're not incentivized, and both of our firms have meaningful skin in the game, and personally, on both sides of this conversation, to make sure these are institutional quality and like best execution deals. Conversely, brokers are all transaction focused, so they just want to get the trade closed. A couple deals we passed on for diligence purposes that are completely separate. We looked at a robotics company they just raised a large financing round at a 10 billion valuations. We did 8 different calls with the CFO and CEO, vetting the business. We were under NDA, had full access to the data room, financial projections. We understood other participants in the round as well. So we were talking through kind of reference checks to other private equity firms that were potentially participating along the way. Ultimately flew out to Palo Alto to meet the management team, do an on-site. Before we invest, we're always doing an on-site, physically in person. Like we need an investment team and operational due diligence team in the office, physically in person before we're committing our own capital and client capital.
Yeah, which is
Frankly,
a great point to make also.
Yeah, it's frequent travel. Like we're all over the place, domestically, Western Europe. Like you really need to be there on site because the software was lackluster for this robotics company specifically, like the demo and autonomous mode and the robot didn't work. And we had heard that from other counterparties that were also betting the transaction. They were like, look, the hardware, aka the robot, the humanoid robot itself is really interesting. Like the software needs some work. And so we went in with kind of moderate expectations, but the reality is like they just weren't there on the software model. And the valuation was hard to get comfortable with at 10 billion as well. We were working through like a lot of kind of concerns around the valuation front. So that's where we did 8 different calls over a couple months, documented all these notes into 100 pages of write-up on the business, soup to nuts, flew out 5 individuals to Palo Alto to vet the business, and like ultimately like decided not to proceed with the transaction in the red zone. Another deal that we passed on for totally separate reasons is Anthropic. So we did the E round in March, as you noted. Then they did the Series F a couple months ago. We had access through a venture firm. The round got very competitive. So like the company was like basically like restricting all these different groups from participating in the round. They were 5 times oversubscribed with demand. They had the ability to really get tight on the round. And so it got hard to get access to the Series F round, particularly. We had one venture firm that was going to provide us access through their SPV. On paper, this was a very blue chip venture firm, 8.5 billion in assets, large institutional limited partners, like clients, investors. On paper, you would see nothing problematic with this firm. When we actually went in and were in their offices physically, as I noted, whether it's a business like this robotics company or it's a venture firm or a counterparty that's intermediating the deal for us, we need to be physically in their offices, show me the stock certificate to make sure proof of existence of shares exists. Oh, I don't want to see the PDF stock certificate. I want to see the electronic stock certificate because we see forged PDF stock certs all the time. Talk to me about your valuation and kind of audit process. I need a side letter that says you're going to give me the shares in an IPO and not liquidate me out and give me cash. Couldn't get there with them on those items, like immediate non-starters for us. We were very incentivized from an investment standpoint to get the deal done. Like we've been collectively bullish on the business
Oh
now
yeah,
for a while, and
that
we
was a
wanted
difficult pill to swallow, but for the right reason for our clients.
right.
Yeah.
Protecting client assets, our own capital as well. We're aligned. We would never. This is a 5-minute explanation that can basically be summed up, and we would never risk a penny of investor capital if there's anything operationally or structurally that we can't get comfortable with, even if it's our best idea, like an Anthropic investment where we very much want to participate from the investment side of the table. And so this is really puts, I think, our partnership into an echelon that most groups are not there. And we take the diligence, soup to nuts on not only the investment side, but candidly, like even more on these deals on the operational side, incredibly seriously, because there are a lot of problematic structures, fee structures, counterparties in the marketplace where there's going to be over the next couple of years, probably some pretty difficult outcomes for family office clients, not because they got the investment thesis wrong, simply because like they've been wronged by the counterparty that they partnered with. You just need to be very careful in this marketplace transacting.
Absolutely. Yeah. But again, that's another, in my view, that's a strength of the relationship that we have with your group. So switching gears a little bit, you mentioned this, you bounced around this a little bit earlier, but what do you see happening in the niche that we've been investing in over the last couple of years? What do you see happening over the course of the next 12 or 24 months? Again, just your crystal ball. Obviously, nobody knows. And not only does nobody know, but things can pivot and change at the drop of a dime for whatever reason, government reasons, economic reasons, whatever. But what's your thought process at this point?
Yeah, I think a decent amount of exit activity, specifically IPOs for these businesses. So I'll talk IPOs first. 2026, there are a number of juggernaut IPO candidates for next year. The most hot off the press is SpaceX, where we've done numerous transactions in SpaceX together through the company-run tenders. So the company does a tender every December and June. We've been able to acquire shares through the tender together. This tender they're putting together in December also coincided with anecdotes around them getting the business ready for an IPO next year. We've spoken to a couple groups that are very close to management and Musk specifically, who have really verified the fact the business is progressing towards an IPO. That caught the market off guard. I wouldn't say we've been
Caught me off guard.
it's caught everyone.
Yeah.
Yeah. That's Musk owns 42% of the company. So a lot of these decisions are driven by him, which can create a little bit of volatility in the flow of information. Databricks is another one that we've been really active in together. We did 2 financing rounds earlier this year. The company's grown 60% top line. They're profitable now as of this year. And so the free cash flow profitability puts them in a good spot for IPO. It's a great performer for us. Like, we bought the stock earlier this year at $92.50 per share through the Series J financing round. The company's raising at $190 per share right now. So good outcome where we've made a little over a 2x return on that in the last 10 months for the investment. And they're probably an IPO candidate back half of next year. The business we just recently invested in, Crusoe, which is an AI infrastructure data center developer. They're the firm that's doing the Stargate project in Texas with Oracle and OpenAI, huge data center development project. Crusoe will make $2.3 billion of earnout revenue on that project. Also an IPO candidate, strong IPO candidate for next year. So those are 3 investments that we hold at pretty meaningful size in businesses that are in the Journal and CNBC every day, almost, who will likely IPO middle of next year. So I think you'll see a decent amount of IPO activity in 26. 27, probably a lot of IPO, specifically the frontier labs, AI labs, OpenAI and Anthropic. Ton of articles circulating around them pulling forward the IPO potential of those businesses. I think those are probably, my personal opinion, 2027 timeframes, but they're aiming for like end of next year. I think that's a little ambitious for them, but I think they leak into 27, still pretty near term at this point. And then Anduril is another one you would think, and they've been pretty outspoken about this, will go this administration, like in the Trump administration, probably 2027. So those are 6 companies I just mentioned where we have positions where we'll be monetizing them through IPOs. For the investors, one thing we do when IPOs happen, specific to our partnership, is distribute the stock to end investors in the IPO. So the clients get in-kind distributions of the stock. It's good for 2 reasons. One, if the investors want to hold the position post-IPO, when the stock's public, they can. 2, it doesn't create a tax liability either. So we really focus on providing in-kind distributions of the stock after the IPO lockup expires. That's one dynamic. The only other thing, and I'll be way more brief on the subject, is the private markets are getting much more liquid to the benefit of investors. So there's no market exchange for trading these companies. However, there's a ton of secondary market activity. There's also, these companies are running tenders now regularly for shareholders to liquidate their positions potentially once or twice a year formally. And so even if IPOs languish, the market has progressed to the benefit of shareholders where there's better exit optionality in private markets outside of just a binary IPO outcome. And so both of those dynamics, I think we're really excited about. We've been collectively heavily deploying capital over the last 3 years coming out of 2022, where we had a big reset in this universe and a lot of these companies were formed. And now I think we're going to actually start seeing some real monetization events for these companies over the next 24 months.
Yeah, I would agree with you. That's my personal thoughts as well. And as private companies have been staying private companies much longer for a number of reasons, but I think we're in agreement that the market's becoming pretty hot for some of these longer tenured private companies to consider options such as an IPO or something like that. And then again, it's all a cycle. So things will probably cool off at some point later down the road. And if my crystal ball works, it's probably 2 to 3 years. And then private companies may stay private longer again. But again, I think the market is really strong for this sort of thing at this point.
It is. It is. And you need IPO markets in this space. We've made investments 6 or 7 years ago where you go in, you're like, I love this business. I don't know how I'm going to exit it. This is really attractive. And a lot of times that's not a good strategy. Certain managers will tell you that. They'll be like, look, think about this as being like super long term. We don't know how we're going to monetize the position. Like, we don't need the liquidity. Like, this is the investment merits, like, are hard to argue with. But you really you need pretty clear exit strategy outside of, we could sell this through a secondary or tender out of this. And so when IPO markets start reopening, like it seems like they are this year and especially into next year with a number of these candidates, that tends to be the best time to deploy because like realizations are not super easy to come by in pre-IPO investing. And so that gets us really excited heading into 26.
And what are your thoughts on, and this is more as a generality, maybe not even just where we are right now, but on liquidity? Again, when we talked about SpaceX, I was surprised by that because of a lot of the investments that we've done. I've always felt like SpaceX might be a longer term hold than some of the other investments that we're doing. So give a few thoughts on how you all view liquidity, not just in the current market space, but 3-4 years ago when there wasn't as much liquidity.
Yeah, IPOs were like even more important 3 or 4 years ago. This was that second dynamic I was trying to bring into the fold, which is non-IPO private market liquidity is improving, as you would expect it would. Like, markets become a little bit more efficient and a little bit more liquid. So there are more efficiencies. The thesis behind SpaceX specifically, it's a great example. Unbelievable company, insane growth on the Starlink side, pretty much a complete monopoly on the rocket launch side. They're like 7 or 8 years ahead of the next closest competitor on launch. You have Elon Musk, who has unlimited access to capital and obviously is a visionary and proven founder. That's one handful of years ago where it checks all the boxes you would want for this program. The also profitable business model. Like, both sides of the house, Starlink and the rocket launch side, are profitable, so the unit economics work. The challenge was the IPO looked pretty bleak. Everyone was always giving the generic 3 to 5 year IPO expectation. There's actually reasons why the company could potentially operate better as a private company than a public company, given the sector that they're operating in. You could make the argument. So that would be one within this program where we feel less bullish about an IPO coming into the investment. What we did know that got us comfortable from an exit optionality standpoint is the company runs 2 tenders per year. So every December, every June, they run a tender. The company sets the price and valuation on the tender. They leave the tender open for 20 days. That enables shareholders to liquidate their position through the tender. So we knew, okay, twice a year, there's really good exit optionality in the private markets through these formal tenders that the company's gotten really good at running. In the event the IPO is languishing, we can turn to the tender to monetize the position opportunistically. Also, there's been pretty perennial demand for the stock where the secondary market has had a pretty consistent bid even through market cycle. So bid-ask spreads can widen when markets get squirrely. For a lot of these companies, typically SpaceX has pretty strong bid through 2020 and 2022 in tough markets. And so those two factors gave us comfort where we thought maybe IPO, 50% chance they IPO the business. Ultimately, 50% chance we still have 2 really good exit strategies through tender or secondary. I think if we didn't have optionality for tender or secondary for one of these businesses where we didn't really feel good about an IPO, that would be like a big hurdle diligence wise to get comfortable with. We really want to see IPO visibility. And if there's not a ton of IPO visibility or path towards an IPO, there needs to be very reasonable liquidity optionality through a tender or secondary that we can get comfortable with in order to proceed.
Yep, makes sense. From your vantage point, are you seeing where big pools of capital are flowing into these investments. Obviously, they're flowing in, but is it coming from sovereigns getting involved in this, endowments getting involved? Obviously, the ultra high net worth is clamoring for accessibility to these types of investments. But it's also become, as we know and we've experienced firsthand, that accessibility has really been tightening up over the last year too.
That's correct. Yeah, both true. Tons of capital coming into these companies. When they get a little bit, the sovereigns are coming in now. So to your point, like there's a ton of balance sheet behind those entities and demand that comes alongside it. Also the mutual fund companies are getting involved. So
Yeah, that's true.
and they get involved closer to IPO. Like they don't want to do the business when it's 7 years out, but they want to cross over the stock to their public side. So like when they start getting a little bit later stage, you'll see like big firms like Fidelity and Franklin and T. Rowe. And this is something I touched on with the First Trust kind of part of the story, where the companies really like those crossover investors on the cap table when they get closer to IPO because they know they'll be supportive of the stock after the IPO, but it brings a lot of demand. Like those are large entities who write big checks. So a lot of these rounds are tough to get access to, like the Anthropic rounds and the OpenAI rounds. You need $200 million just to play in those rounds. Like the minimum check sizes on those rounds are generally 200 recently. And then the round they're raising $10 billion because these are CapEx intensive businesses and there's 40 billion of demand for the round. Like the numbers are really hard to frankly wrap your head around a little bit. Like 40 billion of demand in the Anthropic round, and you've 3 guys at Anthropic that are running the book on the round. Like things get challenging to get the transaction closed if you're on the buy side. Like what they start doing is getting extremely restrictive. Groups get cut back, allocations get cut, so it can lead to prorations where you thought you were going to get $20 million in the round and you're only now getting $10 million in the round. So it's a tough, very competitive marketplace, as you'd expect, for these businesses where they have transformational or generational potential. I think that's where collectively we've had a lot of success. A lot of the marketplace that's out marketing these companies are not actually closing the transactions because these rounds are meaningfully oversubscribed. So I'm proud of the fact that we got one Anduril deal in the ground last year that's looking like really attractive cost basis. We participated in the Anthropic round. Databricks was a tough round to get access to. We closed on that transaction. XAI, we did a really attractive secondary, and the company's raising capital this month at a large valuation increase from where we bought the stock. And so to be able to actually not only go out and source and diligence the investments, but actually just take it through closure and execute for the clients has, I think, been something that puts us in kind of the top decile or top quartile of this space.
Well, time will tell on the positions that we're doing. One thing that I always tell our clients is you have to invest in any one of these deals with a mindset that you could lose 100% of your investment. And so that's why I preach diversification. And yet at the same time, I'm so bullish on everything that we've been doing. And that to me is why I really consider it that once in a generation opportunity. I feel like this is the pre-internet boom stage where we're getting access to the real companies that are going to be, when all the dust settles, some of the top companies out there, when there's going to be a lot of Me Too companies that come along and frankly probably take a lot of people's money that is not able to execute and puts those investors at risk of losing all their money. But yeah, it's been just such a unique opportunity. Now, just a couple of the things before we close out. You've mentioned a couple of times us being insiders on the positions and the 6-month holding period. With, again, nobody knows the answer to this, but I would enjoy your insight on just, you could use SpaceX, you could not use any company as an example. By the time the IPO goes through and we as insiders, including our clients, need to hold it for an additional 6 months. And then the benefit of a First Trust and Fidelity and Schwab is they are going to help the stability of those companies at the end of the 6 months. But let's face it, there's probably a lot of people that want to sell at that 6-month period also, which can drive down the price at that point of execution. What are your thoughts on the group of companies that we've been talking about, what do you think they look like if they IPO and we have to hold them for that 6-month period?
Reddit's a good example. We transacted $29 a share. It was $5 billion enterprise value in October 2023. Company goes public in March 24. Stock trades to $100 a share or something post IPO. We were in at the cost basis of $29 a share, so we're feeling pretty good about the thesis playing out on that investment. We're locked up for 6 months. Pre-IPO investors subject to a 6-month lockup agreement. That's not specific to Destiny or First Trust. That's any
All
pre-IPO
insiders.
investor.
Yeah.
Yeah, all insiders. We're locked up for 6 months watching the stock. As the 6-month period approaches, like you start seeing some selling pressure, like coming out of the lock, where the stock falls to $55 a share, all the way down. I think $55 a share is maybe where it bottomed. It's why it's so important to distribute the stock to the investors after the 6-month lockup period, because sometimes you can get some selling pressure and depressed stock prices around the lockup period expiring simply due to like a lot of insiders exiting the position when the lock burns off. Now the stock's trading at it's $220 a share. I mean, it pretty quickly rebounded to $200 a share.
Dude.
And a lot of the clients held on to the position. I would say the majority of them held on to the position because we gave them the stock in kind rather than said, okay, we're going to blow out of the position after 6 months at $55 a share. We still made a 2x on the investment. Here's your cash distribution of long-term capital gains. So you want to think about being prudent around one of the small
It would have been
things
short-term
is just
capital gains.
it would have
Actually.
been, probably
Yeah.
inside, a little bit inside in
Yeah.
short terms. It's another thing. Typically, these are going to be more than 1 year holds, but that
Right.
was a really quick one. So I think we're excited about the IPO and potential there in the next 6 to 9 months and how the stock will be received in public markets. The precedents look pretty good and the companies are really performing. And so I think you're at this perfect storm of strong fundamental performance and probably some benefit in terms of macro environment or timing
For sure.
around these IPOs. And hopefully that bodes well. At the same time, the last comment is we don't bank on the stock. Everyone has a pie in the sky. Not everyone, but a lot of people have a pie in the sky kind of scenario of, oh, I'm going to invest in this company pre-IPO and I'm going to get this massive pop post-IPO and I'm going to make a ton of money on the investment because it's going to, I think we've done a really good job collectively of coming in at big discounts to IPO price and valuation where we don't actually need the stock to trade that well post-IPO to have a really good outcome.
No, we're definitely in a fortunate situation with kind of our pool of investments from a standpoint of entry valuation versus current. And to your point, it'd be great for it to IPO and the IPO do extremely successful over the next 6 months and have an opportunity to have it grow that much more in value. But even if it stays at the pre-IPO price where the valuation is right now, it's still a very good investment on the majority of the investments that we've made. So one last question as we wrap up, but again, we've been pretty focused on these core companies over the last couple of years. What do you think 2026 has in store for perhaps new companies, maybe same sectors, maybe not the same sectors, but what are your thoughts going into the next year?
Yeah, there's some of the big category leading companies are doing what feels like their last financing rounds prior to IPO. So one more bite at the apple for the big kind of category defining companies. It probably stays private a little bit longer, but I think you're running up on timeline for some of these companies to go public. So we're focused collectively on continuing to participate and support these companies pre-IPO in the last couple primary financing rounds that they do. So ones that we think can grow into being category defining companies that you may or may not have heard of. Size of these companies typically ranges from 2 billion market cap to 15 billion market cap. So as we talked about, we're not focused on the $100 million enterprise startup company that's raising a seed round or a Series A round. That's just for how we think collectively about investing our partnership capital, too much risk and speculation. We've mostly Series C to pre-IPO companies. We've been focusing a lot on nuclear energy, so nuclear fusion specifically.
Which I love.
Been a-
Yep.
Yeah, really hot theme, great cocktail and like golf kind of theme, but so that's exciting. Momentum's behind it, but the reality is like technology is finally like really interesting and the duration is not like extremely long for the delivery of these commercially viable nuclear fusion plants. Like a lot of the delivery dates are like 2028, 2029. So you're taking a little bit more duration than like all the businesses we've been talking about where you're going to be public by that point. But super attractive in terms of transformative energy. And there are a couple companies we're in the seventh or eighth inning of diligence on within that subsector. Defense technology, Anduril, we've done a number of Anduril transactions together. It's a big winner. They create, to me, they created the sector of defense tech, like disrupting the defense industry with unbelievable technology that the defense primes simply don't have. So I think we'll do something in defense tech together in Q1 next year. There's one or two other space technology companies that we're looking at. One was recently in the news because it was being looked at by Sam Altman from an acquisition lens or a strategic investment lens. And then some other frontier technologies, robotics, software focused robotics specifically. We looked at the quantum compute company for a while that we've talked about, a wearable health device technology that is bucking substantial revenue with really good financial numbers. So we'll do some away from like the blue chips that we've been focused on. It'll provide some good diversification to our program, and
Awesome.
we'll continue to rely on the category leaders as the main ones that we do throughout the year.
Awesome stuff. Well, listen, it's been a great conversation. Thank you so much for taking the time to join us today.
Sounds great. We appreciate the partnership. Thanks,
Yeah,
Tom.
I do as well.
Talk to you
Thank
soon.
you.
That brings us to the end of today's episode. Thank you for tuning in. Be sure to subscribe to Significance of Wealth on Apple Podcasts, Spotify, and anywhere else you get your podcasts so you never miss an episode. You can also follow Tom Ruggie and Destiny Family Office on LinkedIn and Destiny Family Office's website for more insights on wealth management, private market opportunities, and collectibles. Until next time. The expressed views, thoughts, and opinions belong solely to the host and/or guests and are not investment recommendations or opinions issued by Destiny Wealth Partners or its affiliates. Investment advisory services are offered through Destiny Wealth Partners, LLC, and SEC, registered investment advisor. Destiny Wealth Partners also conducts business under the name Destiny Family Office. Destiny Family Office podcasts are the sole property of Destiny Family Office, and information provided is for informational and educational purposes only. The funds discussed are typically for qualified purchasers, defined as $5 million of investment net worth, exclusive of primary residence. Learn more at www.destinyfamilyoffice.com/disclosures.